Hey, this is Julian McClurkin, your chief storyteller with Tribevest. But today, we're not telling stories, we're learning lessons. This is a masterclass on how to build wealth. I sit down with Jim Pfeiffer, the founder of Left Field Investors, to learn all about passive investing through real estate. Let's go. So we're getting ready for this masterclass, and we're going to start off with the first chapter. Chapter 1 is passive investing. And Jim, let's just start there. What is passive investing?
Traditionally, passive investing is investing that doesn't require much from the investor. So you're not doing anything. You're just putting your money somewhere, and someone else runs the operation for you.
We're here to talk about investing in real estate specifically. So how is that done passively?
In real estate, you basically are sending money to the operator, and they are doing all the work, and the investor has no operational duties. So you send them the money, and they do the investment. Now, there's significant work up front that you have to do to prepare the investment, to vet the operator, make sure you're in the right markets and all that, and we'll talk about that later. But the basics are that passive investing in real estate, you basically wire your money, and then you have nothing else to do.
Got it. When I hear you say the word operator, in my mind, I have like the conductor of a train. And is that kind of similar to what an operator actually is?
Yeah, and we'll talk about that in later chapters, but the operator, the syndicator, the general partner, GP, all of those are the same terms, synonyms for the person who is operating or taking care of your investment property for you while you sit back and just watch the cash roll in.
All right, well, let's talk about some of these investments now. Can you give me some examples of passive investments within the real estate realm?
Yeah, so the main thing we're focusing on in this masterclass is private placement offerings. And we'll talk a lot about those. Those are the syndications. Private placement offerings, those are the same thing. But there's a lot of other things in real estate that you can do that are passive as well. Private lending to house flippers, mortgage notes, crowdfunding websites, tax liens. All of those are also fairly passive. And then one of the most popular ones is investing in single family rentals. Now that sounds passive, but you end up managing your property manager, and it's less passive than you think when you're jumping in on it.
What is the most passive real estate investment you could have? And then what would be like on the opposite realm, what's the most active real estate investment you could have?
So the most passive are these syndications we're going to talk about. That's where you wire someone money, and then they operate it, and every month they send you a check. And after 5 years or so, they send you your capital back, plus hopefully some appreciation.
Mailbox money.
Mailbox money, exactly. You don't have to do anything. The most active would be the opposite of that, where you're maybe a house flipper, so you have to go find the property, buy it, fix it up, or you're buying a property to rent to somebody else, and so you're dealing with, the termites, tenants, and toilets is what people try to avoid, right? But that's kind of what the management process is. So a lot of people have growth from, most people in real estate, they start at the house flipping, or I want to buy a rental property, and they start with the active stuff, and then as they grow and learn, they find passive, and so it's kind of like a migration. And what we try to do at Left Field Investors, and Tribevest helps a lot with this, is maybe skip that active part and just go to passive, right? Do your job, do your W-2 job, whatever you do, and then on the side you can do some passive income investing, which helps you build your wealth.
The real estate market, especially right now, a lot of people are predicting that we might have a correction coming, and because of that, they're sensing some volatility within it. But there's volatility in the stock market as well. Let's talk about a little bit why it would be better. I know you mentioned index funds. Why would it be better to invest in real estate rather than like index funds, which have a constant rise over time?
That's a great question. And index funds they're set it and forget it money, right? But what you're doing when you buy a stock or you buy a mutual fund is you're buying something and betting that someone's going to pay you more for that asset, that paper asset later, right? You're not getting very many dividends. You're not getting very much cash flow. You're hoping someone pays you more for something later. So in real estate, there might be fluctuations in the market price, but I don't care because I'm getting cash flow, and that's what I'm investing for. And the appreciation is just on the back end, and that's a bonus. Another thing with real estate is you can force appreciation, meaning you can make improvements either if you're active yourself or if you're in a syndication, the syndication operator will make improvements to the property that will increase the value of that property regardless of what the market is doing. If you're in index funds, you're coasting with the market.
Yeah.
If you're in real estate, you can create your own value in that asset, and you're always receiving income as you go.
That makes sense. That makes sense because people would look at, investing in stocks and in index funds and saying, an index fund is like, can you explain what an index fund is, where it's spread over multiple companies?
An index fund is where you pick an index. It could be the S&P 500, which is the 500 largest companies in the US, or it could be foreign stocks. And you basically invest in every one of those stocks through a fund, so that you're basically getting the returns of the market. But now it's looking like perhaps if everyone's investing in index funds, then you lose some of that advantage. And the reason people are so much into index funds now is because you don't have to pay someone to actively manage the fund, right? So the expenses are much lower, so your returns are much higher. So it's similar in that they're both passive, what we do, the syndications and index funds, but that's really where it stops. And you'll see as we talk about all the advantages of real estate, that it's really a better way to go than the index funds, in my opinion.
Right. I know, I agree, because there's so many different ways that, your investment, you can force appreciation on your investment. You can't force appreciation on an index fund. It is what it is.
Right.
The price is what it is, and it's going where it's going. So the index fund reduces risk because it kind of spreads your investment around, but with real estate, aren't you a little bit overexposed because all your investment goes into this one thing?
Yeah, that's a good point. So if I had $25,000 to invest in an index fund, it would be spread out over 100, 500 companies, right? But if I'm investing in real estate, syndication, usually the minimums are $25,000, so I'm in just one deal. But there are a lot of ways to spread the risk. You can invest in multiple deals with multiple sponsors, so you're with different operators. You're in different markets, so maybe you have one property in Phoenix and one in Dallas, different asset classes, so maybe you do multifamily apartments and then you also do self-storage. And then you can use a company or a platform like Tribevest to reduce the minimums, right? The minimum's $25,000, but if you go in with 4 of your friends, now you can get into these deals for $5,000. And so if you have $25,000 to invest through Tribevest, now you're in 5 different deals, maybe you're in 3 different markets, 2 different asset classes, and that's how you get diversification and you decrease the risk of the investment.
That's awesome. It's like you created your own stock market.
It's exactly right, and that's what you try to do, is you try to balance it out with different investments, different places, and you're creating your own real estate syndication index.
That's
almost.
Awesome. Yeah, that's cool. That's cool. Investing in real estate seems like it's more difficult than just putting your money into these index funds. Just in summary of this chapter, what would you say to somebody who's looking to invest some money and they're trying to make the decision between real estate and the stock market?
Well, as with a lot of things, it is complicated until you know and understand it and learn it a little bit. And the purpose of this webinar and the purpose of Left Field Investors is to educate people on alternative investments. I don't like that word because alternative means basically just not Wall Street stuff, right? But it's not alternative, it's the house you live, it's where you store your stuff at the self-storage facility. I mean, they're real assets. But there's a bunch of benefits to real estate investing that you don't get from the stock market. And you'll learn about those throughout this webinar, but some of them there's significant tax advantages. You can use leverage to increase your returns. It's comparatively stable markets. Your asset values aren't going up and down as much. You have protection from inflation and consistent cash flow. And then the appreciation, that's just the bonus. All the other stuff is the best part. And then appreciation is like, you don't need it, but you love it when you get it.
Well, stay tuned for the next episode. We mentioned a lot about syndication. We're going to be harping on that a little bit on the next one. Welcome back to the Masterclass. We're now on to Chapter 2, Syndications. Jim, what is a syndication?
A syndication is basically just a pooling of capital to be able to go buy typically one, but maybe more properties. So it's typically a property that someone might not be able to purchase on their own. A good example is, let's say you want to buy a $20 million apartment building. Well, most people don't have $20 million sitting in the bank that they can go buy this apartment building with, but you think, okay, I'll go to the bank and get a loan for 75%. So there's $15 million you're going to get from the bank. You still need another $5 million. Again, most people don't have $5 million sitting in their pocket to go buy these properties. So what they do is the syndicator, the operator, we'll talk about that more later, they get maybe, let's say, 100 people to each put in $50,000, and now you have your $5 million for the down payment. And that's, the syndication is the operation of running that apartment building now that you've bought it.
Yeah, but 100 people, that seems like a lot of people to get on the same page about an investment. How do you get that many people on the same page?
That's a good question, because what you do is they create an LLC, a limited liability company. That's just a way of owning something. And there's in an LLC, you can have general partners and limited partners. So the general partners are the operators, the syndicators, the people that are running and managing the deal. The limited partners are you and me. We're the investors. We're the ones giving them $50,000. We don't have any responsibilities after we give them that money. Now, when they operate, they have to do everything. They have to find the deal. They have to negotiate the deal. They have to sign all the documents and make sure that they get all the funding from us, the LPs, limited partners, and also the bank. So they have to do all of that. And then once they've closed the deal, they have to operate it. They have to communicate with the LPs. They have to send out reports to the LPs. Hopefully they send distributions of cash to the LPs. And then they operate it. So they deal with what we talked about earlier, the tenants, termites, and toilets, right? They have to repair things and they manage the property. Another thing about syndications is it used to be really just reserved for the wealthy. But Congress passed the 2012 Jobs Act. There's a regulation in there called Regulation D. You don't need to jump into the weeds and read that at all, but it talks about 506B syndications and 506C syndications, and that's usually what we're dealing with.
What is the difference between the 506B, C, D, and F?
I can't talk about D, E, and F, or just 506B and 506C. So there's two parts to each of those. One is what kind of investors they can allow into the deal, and the other is, are they allowed to advertise or not? And so the type of investors they're talking about, whether you're accredited or non-accredited. And accredited, they just broadened it, but accredited basically means you either have $1 million in assets outside of your home, or you earn, over the last couple of years, $200,000 or more if you're filing single, or $300,000 filing jointly. Now, there's also a couple little caveats. If you pass a few securities tests, you can also become an accredited investor. And all that means is the accredited investor has access to a lot more deals. Now, I found through using Tribevest, one of my tribes, we had a bunch of non-accredited investors. And that really got me out there looking for non-accredited deals. And they're out there. And they're just as good as the others. And I invest in both. So the only disadvantage to being non-accredited is you have a little bit less choice.
Understood. In the housing market, I'm an agent. When I am submitting offers, it seems that other agents rank different types of financing that comes through. You have the best, which is cash, then you have conventional, then you have FHA, then you have VA and USDA. It sounds like when you're going to purchase deals, it's better to be an accredited investor rather than a non-accredited. Or is it non-accredited?
Yep.
Yeah. But using platforms like Tribevest, like you said, you can become an accredited investor by using your whole team, or is it just a group of non-accredited investors now have access to something that normally only an accredited investor would have access to?
Yeah, the way that Tribevest helps is not really with the accreditation, because if one person in your group is non-accredited, then your whole group is non-accredited.
If they're on the LLC?
Yeah.
Okay,
yeah.
okay.
But what Tribevest allows you to do is, like I have a group I'll talk about later, that we contribute $100 a month. So it's real small stakes, but you can get into these syndications. And so all these people in this group with me are non-accredited. So the investment opportunities out there, I didn't think were equal to what an accredited person could invest in. And
right.
In fact, they're not. But there are plenty of syndicators who target the non-accredited groups and will let you in their deals. So it's not as big of a disadvantage as I originally thought. This used to be for the wealthy, and the wealthy still have some advantages, but the regular person can get in it too. Got
it. Okay, so let's assume that I have $50,000 to put into a syndication. Why not just go off and buy a single family home on my own?
A lot of people do start in active investing, doing wholesaling or buying single-family homes, as we talked about in the last chapter. But the reason why you might want to put it into a syndication is because it's passive. You don't have to do anything. After you've decided on the investment, decided on the sponsor, all that stuff that we're going to talk about, then you turn over the operational duties to somebody else, somebody professionally who is trained to do this and only this runs your real estate operation for you, right? I was investing actively in my own stuff, and I thought, why don't I just have a professional do it? Because I have my regular job, and now I'm trying to manage a single-family home on the side. It's much more effective to have somebody else do it professionally, and the returns, honestly, are not that much less than I was getting on the active stuff.
So how are the profit return splits different between the general partners and the limited partners?
So the general partners, sometimes they don't even put any money into the deal. A lot of them, you like to have them invest as LPs and be GPs at the same time. So general partner, limited partner. So they invest some of their money as limited partners. But the general partner, they're doing all the work. So, but we're providing all the money. So you have to split up the proceeds, right? So typically what they do is they usually, a lot of syndications offer a preferred return. A preferred return is also called a pref. And what that is basically, it's usually between 6 and 10%. And they say, okay, I'm going to pay you every month 7% out of cash flow from based on how the property is doing. So if one quarter they only pay you 4%, they have to make up the rest. And so at the end, when they're selling the property, that's when they make up. If they haven't paid that 7% consistently, the first thing they'll do is they'll make up that 7% and make the LPs whole, right, on our cash flows. Then they'll return all of the capital, so that's your initial $50,000 investment or whatever it is, and then everything else is split based on a predetermined amount. Usually it's 80-20, 70-30, 60-40, with the bulk of it going to the LPs. And that is all taken care of on the back end, if that makes sense.
No, it does. So they're guaranteed a certain amount.
There's no guarantees.
Okay.
And if you ever, this is a great question. If you ever get an operator offering you a guarantee, you say thank you, no thank you, and you exit, because they can't guarantee anything. That's I don't know if it's against the law necessarily, but they should not be guaranteeing you returns. What a preferred return is, it means that you get paid, the LP gets paid before the GP gets anything. So if the deal goes south and there's only 5% returns on this, the GP gets nothing. So it's basically they're paid for their performance, but to get you to invest, they want to say, hey, I'm going to make sure you get 7% as we go through the investment. Now, it's not guaranteed. It might not get 7%, but when they sell the asset, that's when they backfill and pay you for anything that they had missed.
So in a syndication, who typically gets more, a limited partner or a general partner?
Well, the limited partner will get more cash, but they also put in more cash, where the GP didn't put anything in. They put it in on the LP side, but they're not putting anything in other than their sweat equity, right? So they're not putting anything in. The other thing to look for is the transaction and operational fees. So the GP also gets paid for that. There's acquisition fees, perhaps, disposition fees. So they might get 1% of the total value of the property when they buy it. And that's just so they can do all their due diligence and cover all of their expenses. And then there could be other fees. There's an asset management fee usually of 2 to 3% that's paid annually because they're managing that asset. And so there's other fees that you have to look for when you're investing. But the typical ones are acquisition, which is when you buy it, disposition, when you sell it, and then the ongoing is the asset management fee.
There's fees for each of those levels, is what you're saying? Acquisitions fee, dispositions fee, and then management fee?
Asset management fee, that's the one that's recurring. The others are typically one-time fees. You buy it, you pay them they get 1% of the total purchase price, and that's for all the work that they're doing up front. And then they get same percent, usually 1% on the back end, because they're not getting the cash flow as you go, and that's what they need the asset management fee, because they manage the whole property. They usually hire a property manager, so that's a separate fee, but that's not paid to the general partners. The general partners get an asset management fee.
Okay, so if I want to invest in this syndication, which I kind of do with this $50,000, what's the process?
Well, for the LP, all the active stuff is up front. You have to do your due diligence, and we'll talk about all of this coming up in later chapters, but you need to vet the sponsor, decide on a market, pick the asset class, and then vet the deal, right? So there's a lot of upfront stuff. After that, you're not really doing anything. But left field investors, the community that I'm part of, there's tools that we have will help you along the way. So one of the most important parts is vetting the sponsor, which we'll go into detail later. But left field investors has a sponsor screener tool that helps the new investor come up with the questions to ask when you're talking to the sponsor for the first time. And so that's part of it. You have to screen the sponsor. Then you have to pick the market, like I said, screen the deal. And for the deal, we also at Left Field Investors, we have a deal analyzer, which basically we'll talk about a little bit later, takes some metrics, you put those metrics in and you make sure the deal kind of checks all the boxes. We don't want to re-underwrite the deal, that's what the sponsor should be doing for us, but we do want to check and make sure that it hits all the right numbers that we're looking at. After you analyze the deal, then you're going to get a bunch of documents from the sponsor, the GP.
What are these documents?
Yeah, so you get the private placement memorandum. They call it the PPM. It's 100, 200 pages with all the things that can go wrong. It's all for the lawyers. The lawyers write it, the lawyers read it.
Yeah.
I recommend when you get into a deal with a new sponsor, you read it, you look at it, and you're not going to read every word. It's a lot. Nope. But there's ways, and we talk about that. Part of the community aspect of this is people know, hey, look for this, look for that in the PPM. And that's one of the things you need to do. There's also an operating agreement for the LLC because each property that you buy is going to have its own LLC. So you want to check out the operating agreement. And then there's subscription agreements that you have to sign. And that's where the operator is getting information about you. How are you investing as an individual or as an LLC? They need your social security number and some other, your address, your phone, all the private information. After that, you send the wire and then you just wait for the cash to roll in. After you've invested, you've sent your wire, money's coming in, then you'll get monthly or quarterly distribution checks and reports. So you need to read those and you'll find out how your property's doing. And then around March 15th, tax time, you'll get a K1. And that's a specific document that lays out how the taxes are paid. And we'll talk about that later. But you have to be on the lookout for the K1. And the next thing you do is you wait around for the next year and eventually the deal sells and then you collect your capital and the appreciation.
Nice. That concludes chapter 2. We're going to move on to chapter 3. Welcome back to the Masterclass. It's time for chapter 3 with passive syndications, pros and cons. So far, syndications sound pretty cool, but I'm sure there's some downsides. What are some of those?
Yeah, so I think the major downside to syndications is you're giving up control and they're very illiquid, right? So when you buy into one of these deals, it's going to be 3 years at a minimum probably, and could be 5 or 10 years before you can get your capital back. So you don't have a lot of liquidity. There's no secondary market to sell these. So that can be a downside.
What is liquidity?
Liquidity is having cash, right? Cash is liquid, but if you go buy a house, it's not liquid because if you need money, you got to sell the house and that takes time.
Okay, so liquidity, it's access to your cash.
Yeah, exactly.
Okay.
That's a great way to put it. So you lose liquidity with these, which is a definite downside. You also don't have control over the asset. But I would say if you're investing in the stock market, you also don't have control, but you do have liquidity. And that, not to turn all of the downsides into upsides, but not having liquidity sometimes can be a good thing. Last year when we had the pandemic and the stock market dropped 30%, if you sold at the low and stayed out, the liquidity hurt you, right? But in the real estate market, I wasn't selling, I just held because I had to, and everything came back. And so you don't end up having the panic selling as much. So that it is a downside to have that illiquidity, and you need to know that going in before you invest in one, but it can also save you. So you should never invest in a syndication money that you think you're going to need in the next 5 years or something.
Yeah, sometimes it's good not to have access to too much money because the more access you have to it, the more you'll spend.
Exactly. That's exactly right.
Is that the only downside, the liquidity?
Another downside is the minimums, right? The minimum investment is $25,000 or it could be up to $100,000. So to get into, we talked about, and we'll talk more about diversifying, if you need $25,000 to get into a deal, how many deals can the regular person get into in a year? So that's a real challenge. And that's where Tribevest has a great solution, right? Tribevest, as we talked about before, allows groups to pool their money together. So you can get into, if you have $25,000 to invest, you could get it, if you have a group of 5, now you can get into 5 deals instead of just one. So again, it is a downside that the investment minimums are so high, but you can get around that by group investing. So we talked a little bit about K1s. Those are a tax document this is getting in the weeds a little bit, but I think it's important. The LLC does not pay taxes. It's a pass-through entity. So it passes through its tax burden to all of the LPs, all of the owners. And they do that through a K1. And the K1 is the document you get. It's like a 1099 that people get for their stock market. But the K1 will list losses, gains. It just lists a bunch of stuff that your accountant will look at and put in a bucket, and then that tax comes directly to you. So the problem is those aren't filed usually until March 15th, March 31st, something like that. So if you're going to file your taxes on time on April 15th, you have to know that your K1s are coming in on time so you can do your own tax return. So every investment you do in a syndication is going to send you a different K1. So now you are adding up some accounting costs. If you have an accountant, every K1 they're going to charge you for, and it is a little bit, it complicates things. But for me, I'll take that complication and that little extra work that my accountant might have to do for the benefits of syndication investing, which we've talked about. So a couple other minor downsides or obstacles maybe is you have to do the deal, you're going to have to wire $25,000, $50,000, $100,000 to someone you probably haven't met. You've had a few conversations with them, so you really need to vet the sponsor and become comfortable enough to be able to send that money out. Another thing is the PPM we talked about, right? Private placement memorandum. Could be 100 pages, 200 pages. Dealing with those documents is frustrating. It's time consuming to dig through them. So it's just an added layer of friction, right? But all of those things I think you get around when you start getting to the upsides, which hopefully we'll talk about next.
Yeah, I definitely want to get into the upsides, and I'm hoping there are some after all those downsides.
Absolutely. One of the biggest upsides is the tax, right? If you're investing or anytime you're making money, the biggest, not risk factor, but the biggest factor working against you is taxes. And you can reduce, defer, even eliminate almost all of the tax when you invest in real estate, because the tax code is written to part of it is written to benefit real estate investors, right? So there's depreciation, which means the useful life of something is less and less as it gets older. So you can use that depreciation to offset almost all of your passive gains. So if you're doing it right when you're investing in a syndication, you will not pay tax on any of the cash flows you receive. It will be deferred probably, and you have to recapture later, and we'll talk about that, but it's your tax bill is going to go way down the more syndications you invest in.
But your accountant needs to know about all of the benefits.
Yes, it's very important that you have an accountant that understands real estate, and preferably someone who invests in real estate themselves, because there's depreciation, and there's something called bonus depreciation, which means instead of depreciating part of the building every year, you can depreciate it all up front. So companies do what's called a cost segregation. Again, fancy term, you get engineers in the building and they run their numbers and they figure out what can depreciate when. And so if you can get, let's say you invest $50,000 in a syndication. I've had syndications come back with the K1, which says what the taxes are, that I have a $55,000 loss in the first year. So I've already received some income from this property, but for tax purposes, I have a $55,000 loss. I can use that to offset income from that syndication. Also, I can use that to offset income from any real estate transaction that I have. So if you keep this bucket of losses, anytime you win, you just eat away at it. And then there is depreciation recapture at the end. And this is where when you sell the building, remember all that bonus depreciation I talked about that you took as a loss? Now you have to recapture it. And so that's where you would be taxed. However, you just made some money, right? Because you sold the investment. Now if you take that same money and go invest it in a new deal.
1031 exchange?
Not a 1031 exchange. My accountant calls it a lazy 1031. So a 1031 exchange is where you can defer tax by buying a similar property, right? The lazy 1031 is instead of buying a similar property, you just buy another syndication. You get another round of bonus depreciation to offset the recapture you just had. I know this is getting complicated, but basically somebody in my network calls it the golden hamster wheel, right? You get on this thing, you have this depreciation. When you sell, you recapture it, but then you go buy a new asset and you get the bonus depreciation again that cancels out that recapture, and you just keep going.
It kind of sounds like the Burr method of tax.
Yeah, that's a good way of looking at it. It's like, as long as you keep going,
it's a rinse and repeat.
Right. You can defer most of your tax, and so you'll make this money and you won't be taxed on it. And so even if you're getting a better return in the stock market, which personally I don't think you do, you have to pay tax on it. There's no way to defer that tax. This tax you can push off, and the longer you push off the tax, the better it is for you in your financial situation.
Oh man, that's huge. Yeah, that's huge. You gotta pay taxes immediately with gains in the stock market. Like there is no rollover or 1031 exchange for stock or a lazy 1031 with stock market gains.
Exactly.
That's so true.
And taxes are the biggest obstacle to creating wealth, and real estate removes that obstacle.
Well, this is sounding great so far. What are the other benefits?
So we talked about it a little bit already, but diversification, right? I think that's a great benefit that people don't think of when you're thinking of real estate, because they think, oh, I can only afford this one property. But again, if you use things like Tribevest or a way to get into multiple syndications, then you do have that diversification. And the group investing is another advantage. You can't really group invest in the stock market, right? But group investing, what it does, it not only reduces the minimums, but also gives you confidence, right? When I found out somebody else in my network was investing in the same deal as I was, I thought, oh man, this is a smart guy. So now I have somebody else who's doing the same thing. And that community of group investing really just kind of solidifies a lot of what you're doing, because you understand other people are doing it too.
Are there any other benefits?
Yeah, there's a bunch, and we're not going to go through them all, but another one is the management of the asset, right? You don't have to manage it. You do a lot of upfront work, and then you give your money to somebody else, and they manage the asset and just return money to you. So I think that's a great advantage. There's also different investing strategies. Just like in the stock market, if you want to buy foreign index funds and U.S. funds, there's all kinds of different options. And it's the same way. There's a bunch of different asset classes, and if you really want to get into it, you can invest overseas as well. So there's a lot of ways to diversify and distribute your investments. A couple other things I'd like to mention is, one is community. Again, either through Tribevest, Left Field Investors, or whatever community you're in, just working with other people and creating a group so you can talk and understand. And that's how much you just accelerate your learning process. You can get into so many different things. There's also one thing that I really like. One of the biggest advantages, other than tax advantages, it's velocity of money.
What do you mean by velocity of money?
So you don't want your money just sitting still, right? So you want to keep it moving into multiple assets. So an example, let's say you invest your $25,000 in a real estate syndication, and that syndicator goes and they try to force the equity to grow, right? So they force appreciation. And they do that by rehabbing the apartments. They might do dog fences around lower level apartments and charge an extra $50 a month. And the thing is, when you charge an extra $50 a month rent, it seems like a small thing. Or when you spend $5,000 rehabbing an apartment and you only raise the rent $100, I mean, do the math. It takes forever to pay that off, but you're thinking of it wrong. What that does is that $100 increase in rent is $1,200 a year. And if you do that on 100 apartments, now you've increased the income of that property, which then increases the value of the property, right? So you do a little thing that increases the value because you're using leverage multiple times. So what ends up happening, the velocity of money, is you do all these improvements, or the operator does, right? You're an LP, so you just sit back, you're not doing anything. But the GP does, they improve the property, then they go to the bank and they say, hey, you know that building that was worth $20 million? It's now worth $30 million. I'd like a new loan. And the bank says, okay. And they give you the loan, right? Now, what does the operator do with all that cash? They send it back to you. So now, let's say they did it so you're 25 grand invested. In 2 years, they give you your $25,000 back. You still own that asset. You're still getting cash flow from that asset, but you have your capital back, and you go put it in a new deal.
Wow.
Now, you have $25,000 that you invested. Now you own 2 cash flowing properties, and it just snowballs. So velocity of money is putting your money into action and not letting it just sit there. But as soon as you get the initial investment back, you go do another one, and now you have 2 sets of returns.
Man, that would be a dream investment, to invest $25,000 and then get it back in a couple of years and continue to get a paycheck from that initial investment. That would be amazing. I'd give you 50 the next time.
All right, give it to me.
Oh, the way my account's set up. That does it for chapter 3. You know it comes after 3, right? Welcome back to the Masterclass. Chapter 4, we're going to be talking about how to pick a sponsor. All right, so we've mentioned picking a sponsor, but how do you find somebody that you like, know, and trust?
This is the most important part of syndication investing. So if you've skipped all the other chapters, you're in the right spot picking this one to start with, because this is critical. Because you can have a great investment run by a bad sponsor, and it's going to be horrible. Or you can have a bad investment run by a great sponsor, and they can maybe save it, right? So you need to make sure that you're getting a good sponsor. And there's a lot of ways to vet the sponsor, but it's complicated because you're only going to get to talk to them for a half hour for a couple of calls. Maybe you can go visit them, but that's not practical for every deal. So picking the sponsor is critical. And one of the best ways is to use your network. I know I keep talking about community, but that's really, really where it's at. So if you have a community like Left Field Investors or Tribevest, talk to the people in that community. Hey, have you ever heard of this syndicator? And that's what we do in our community. We have a list of syndicators that we haven't screened them, but we've talked to them all. And so
they're trusted.
And that gives everybody a little bit of a head start. Ask people, refer me to your favorite sponsor. Left Field Investors website has a long list of sponsors that we've talked to and that we understand, that we think, we don't endorse them necessarily, but that's how. And if it's not Left Field Investors, go to another community and find sponsors that they like. So you need to find some sponsors, get some background info, and then dig deep and do some research on them.
Yeah, Google is your friend on this one, it sounds like.
Exactly right.
But what kind of information should I be looking for with these sponsors?
So one of the biggest ones is experience. How long have they been doing this? Because right now, the last, 10 years, the real estate market has been great.
Yeah.
Right? It's hard to lose money. So what you want is an experienced operator. If you can find someone who's been doing it for 15 or 20 years and they've been through some of the bad markets, that's great. And it doesn't necessarily have to be the syndicator. It could be a new syndicator that has a real estate person who's had that track record. So track record is important. If you could find a sponsor who's had exited deals, right? Because these deals take 3, 5, 10 years before they go full cycle. And full cycle means purchase, operate, sell. So you want to see how many deals have they exited. So do they have experience that they can sell and do the deals they did when they sold them? Did they match up with their predictions, 5 years before when they bought it? So that's part of it. Is you're looking for experience. You're looking for people who have exits. Those are some of the things to look for.
So you can kind of see their stat sheet. You can see what their shooting percentage is.
Exactly.
Yeah.
Exactly. The other thing, compared to basketball, right? Scouting. You go, you read their website, find out what they're saying. You listen to their podcast. You would watch someone play, right? If they're saying all this stuff in their podcast, then you got to see, all right, are they checking it? Are they doing it?
Yeah.
And part of the thing now with podcasting is there are some really, really good syndication marketers out there. Now, are they really good syndication operators? I don't know. Some of them are better marketers than they are operators. And so part of the challenge is you have to figure out which one are they. Are they a marketer? Are they an operator? Or are they both? Because that could be the case too. And that's where referrals and research helps you out.
All right, so what happens during a typical call when you're on the phone with one of these sponsors?
So, they have to screen you just like you're screening them, right? The Regulation D that we talked about has a bunch of rules for they have to know and have an existing relationship with you depending on how they structured their deal, right? It might be that they can advertise, it might be that they can't. So almost every time you want to invest in a deal, you'll have to call and talk to the sponsor. Might be 30 minutes, might be an hour. And so what they're going to do is they're going to ask you questions. They're going to want to find out if you're accredited. They want to know if you've done deals before. They're trying to kind of scope you out to see if you're worth their time. And then after that, then they're going to talk about their operation, what typical deals they do, and they just kind of give you an overview because they're kind of selling to you, right? So what we do at Left Field Investors is we came up with a thing we call the sponsor screener. Because the first time you call, and I've dealt with a lot of first-time investors, and they say, what am I supposed to say? I don't know what to say. And the syndicator, the operator, kind of runs it. But if you have a list, we have a list of questions that you ask. So you just listen, take notes, and then if they don't ask some of the questions or if they don't answer some of the questions on our list, then you just ask them those questions, and they'll give you their answers, and then you kind of take that in and evaluate it. The other thing is, you're not just listening for facts, you're listening for feelings. I know this is really hard, but if you have a gut feeling like, I just don't know, they seem kind of shifty, I'm not sure about them, listen to that.
Yeah.
Right? Do not invest because I've been in a couple of bad deals, and I probably should have been able to figure it out just from the first call. Don't get so excited about investing in a deal that you overlook the sponsor. There are plenty of sponsors. If you get a bad feeling about one, even if other people have said they're great, move on to the next one.
That concludes chapter 4. On to the next one. Welcome back to the Masterclass. This is now chapter 5, and we're going to focus on how to pick an asset class. Jim, how do you decide what asset class to invest in?
Well, you got to start first by knowing what are the options, right? And there are a lot of options. So you have the first, the most popular, multifamily, self-storage, mobile home parks. That's what everyone's after these days. You also have triple net leases, either industrial or commercial. Now, triple net means the tenant pays real estate, taxes, maintenance, and repairs, and the insurance.
Ooh, I like that.
Exactly.
It's like a triple double.
Yeah, triple nets are great. I love those too. And then office and retail are pretty common also, but they are not as popular now given the pandemic and what that's done to those industries.
What are some other classes?
So some of the lesser known classes would be ATM machines, private notes, so mortgage notes, private lending, assisted living facilities, resort properties, agriculture, student housing, oil and gas, and then development.
That's a pretty long list. I wouldn't even know where to start.
You start with what you know, right? So you probably have lived in an apartment at some point. You might have used a self-storage unit at some time. You've probably used an ATM before, right? So start with the things that you know and understand, and then branch out from there and figure out, is there something else I could do? A lot of people, I talked about this, a lot of people get started flipping single-family homes, and then they move on to maybe buy and hold, and then they move on to maybe buying small commercial multifamily properties. And so if you do that, you'll get a sense of, okay, now I'm going to get into this syndication thing and do it passively, and so then maybe you go into an apartment building. And then you learn about apartment buildings, and you learn how great those are, and then you think, everyone's talking about mobile home parks. Well, now you have some experience with investing in places where people live. Now you say, okay, how do I transfer that to a mobile home park? So you just kind of keep going, use your community. Mm-hmm. That's where I keep saying it, Left Field Investors and Tribevest, they help you learn more stuff, right? So you could talk to other people that are investing in these other assets and find out what works best for you. Because there's some people that specialize in one or the other, and there's syndicators. Usually the syndicators only do one thing, but they're branching out also. So you got to make sure that they, for example, one of the syndicators I really like, they're multi-family properties, that's all they ever did. They started into self-storage. Mm-hmm. Now, if they try to do that themselves, there's no chance I would invest with them. Yeah. But what they did is they hired a self-storage expert as a full-time employee who's done it for 30 years. And so, okay, now I can go and evaluate their deals. If that makes sense. Mm-hmm.
Because now they're bringing expertise into the deal with them.
Right.
With all of these different asset classes, is there one that's like more safe than the other? I know as I'm looking at this list, the first one that I actually got involved in was probably mobile home parks. I purchased my first piece of real estate, it's not even real estate, was a mobile home. And I bought it for like $1,000, fixed it up, and resold it for like $7,000.
Nice.
Yeah.
Yeah, I think it's difficult to know what is the safest. One thing that people say a lot is you always need a place to live, right? So if you're investing in multifamily apartments or you're investing in mobile homes, people are always going to need those. So that might be the safest, but really all of these are an asset, right? It's a real asset. It's not a piece of paper. You're investing in an asset. So it's very rare that any of these go to zero. Is there risk? Yes. I think the risk is a lot less in real estate and most of these assets than other things that you're in. But then if you're going to do resort investing, or you're going to do retail or office right now, right after a pandemic, those might have a little bit more risk. Or assisted living facilities, right? You're waiting for demographics to make those a great investment, but they probably will be. So you just have to do your research and understand, where you're comfortable. Start there, and then you'll start branching out. And one of the things that everyone talks about in our group is the shiny object syndrome.
Oh yeah.
So shiny object syndrome, I think of it as the movie from Up, Squirrel, where the dog goes squirrel running around. And I had that, right? When I first started in passive investing, I had an old 401k, right, that I rolled over, and I turned it into something I could invest out of. And that's a whole different story. But I was investing in all kinds of different stuff that I didn't vet properly because I didn't know what I was doing yet, because I had that shiny object syndrome. Someone would be talking to you and someone would say squirrel, and I'd run over there and go invest in whatever they told me to invest in. Yeah. And so that's part of why we started Left Field Investors, was to give people, okay, you can still do the shiny object and run around, but maybe just invest in things that you know and understand.
Is there a strategy involved when it comes to selecting your asset class you want to invest in?
Yeah, I think after you've kind of gotten through the beginning stage where you're only investing in a couple things, and most people probably start with multifamily homes and multifamily apartment buildings, and that's probably a smart way to start. Then you need to start thinking, where do things fit in your investment portfolio? Are you investing for cash flow? Are you investing for appreciation? Are you investing for both? So an example would be, if you're investing, if you're doing private lending, right, you're not going to get any appreciation there. So if you're trying to grow your wealth, private lending probably isn't the best place to do that. If you're investing for cash flow, you might want to invest in ATMs, and there's no appreciation there. You just get cash every month, and then at the end, you've been paid back plus some, but there's no asset left.
It's literally cash flow.
Yeah, exactly. So you have to match what you're doing with everything else. And also, if you want major tax write-offs, again, ATMs is a good investment, and others aren't as good. So you need to try to match your strategy to the asset class. And as you grow and learn and get into the syndication space, you will find all these different asset classes that you didn't know of, and then you could start picking the right one for the strategy at the time. So when I first started, I had sold all of my multifamily properties. So I had a big tax liability. My accountant said, you need to do a lazy 1031, right? So what I did was I found a syndicator who did a great job of doing that bonus depreciation that we talked about, that gave me these big losses that I could use to offset my gains. So that's why I picked that strategy. But then I kept investing with that operator because I liked them, but I had switched, and now I needed cash flow, right? Because I wasn't working my W-2 job anymore. So now I was investing in these deals that didn't have a lot of cash flow, but that's what I needed. And so then I realized, okay, I need to change my strategy because I've written off all this tax liability I can. Now I need to go start investing for cash flow. And so that's kind of how you do it. You have to figure out what you're looking for. You want to diversify, but you don't want to diversify just for the sake of diversifying. You need to make sure that you have a good strategy for how you're accumulating your assets and how they all work together.
When you say you're able to record major losses when you went with that syndicator, it was as a result of you investing in that syndication. That reflects a loss on your taxes?
Yeah, so it's the bonus depreciation, the cost segregation that we talked about earlier. So that's the one where I invested $50,000, and on my K1 they sent me back a $55,000 loss.
Yeah.
Which was great because it's a paper loss, and what that does is I can offset that $55,000 can offset the gain I had from selling another property. So if I had a capital gain of $60,000, now I only have a $5,000 gain, and so instead of paying taxes on $60,000 or whatever the numbers were, I'm only paying it on $5,000.
Okay.
And that's where you make your money, right? Because now you're not paying tax.
So that concludes chapter 5. On to the next chapter. Welcome back to the Masterclass. We're now on to chapter 6. We're flying through this thing. Now, you talked about how to pick a sponsor and an asset class. The third way you talked about was diversifying by market. Can you tell us about that?
Yeah, so you want to be in different markets. You don't want to be in everything in Dallas. You want to diversify a little bit, but you want to be in good markets. So you have to find markets where sometimes the popular markets are a good place to start. Right now it's Phoenix, Dallas, Atlanta. Those are some of the popular markets. It's also, I think, I like to look for off markets that aren't popular yet, like Boise is one, Colorado Springs is another one. So you want to find markets that are either good now or are going to be good.
Well, what separates a good market from a not so good market?
One of the main factors to call it a good market is population growth, right? You want people to be moving there. So whatever the reason is or why they're moving, a lot of people are moving to Dallas, a lot of people are moving to Texas, to Florida, some of the Sun Belt states, Arizona. So the more people there are, the more they're going to need real estate, right? So you follow the population growth. Another good aspect of a market would be where the state has good landlord-tenant laws, meaning in favor of the landlord, or they have no taxes like Florida, so there's no state income tax, so that helps you out. There could be, they just have nice business regulations that are business friendly. So all of these things make a good market. You also want job growth. And if people are moving there, they're generally moving there for jobs. But you want strong, stable, and diversified jobs. So you don't want to, go to a town that maybe a military town, because if the military pulls out, then there's no jobs left. So you want to have a diverse economy with a lot of different employers. And hopefully you could get a place where major companies are moving their headquarters, or they're moving large groups of people there. And so job growth and population growth are some of the big factors.
Well, you've labeled what a good market is. What's a not so good market?
Well, I would say it's kind of just the opposite, right? It's people are leaving, or there's high regulation. So a bad market would be, a place like maybe New York that has high cost of living, people are moving out, there's high regulations. But it doesn't always have to be a bad market. I'm also investing with a guy in New York because he's a local guy, and everyone looks at New York and says, bad market, not going there. Well, he's a local guy. He knows how the rent control works. He knows how everything works. People have to live, right, somewhere.
Yep.
So he is successful there. Now, I typically don't go in New York for my investments, but you find little pockets. And so part of it is you want to find either a good market or find an operator who has a good story in a bad market, because that can be an advantage too. And other things you can do when you get an actual deal is you can go onto Google Maps and just take a tour, right? See what's around it. You could be in a place that is a bad neighborhood, but they're building a brand new Walgreens across the street. Well, Walgreens does a ton of research. So if they're building there, chances are that neighborhood's going to turn around, right? You can go on Trulia and they have a crime map. And so what I do is I type the address in, put it on Trulia, and I'm just looking for how blue is it compared to the neighboring places, right? So there's a lot of things you can do to look at so you want to analyze the overall market, but then when you're analyzing a specific deal, then you look at the sub-market in the very small area where the property is.
Right.
One other thing that might be helpful when you're trying to select a market is a market that you're familiar with, right? If you grew up in Indianapolis and you know something that everybody else doesn't, then that might be a good place to invest in because you know how the market operates. Also, again, I keep saying it, use your community, right? If you want to know what a good market is, ask some other people that are investing there.
So that concludes chapter 6. On to the next chapter. We'll see you there. Okay, Jim, so we've screened a sponsor, we selected an asset class, and we picked a few of our favorite markets. Now we're getting into deal flow. How do we choose the deal we want to invest in?
That's a great question. I'm a passive investor. I do not want to re-underwrite the deal. That's the job of the sponsor, right? So I've done a great deal of work evaluating the sponsor, getting to know, like, and trust the sponsor, and I understand that they know what they're doing, and I'm confident in them. So I don't want to do their job and dig into everything and figure everything out from scratch, right? That's their job. Now that I have confidence in them, I'm going to trust that the deal meets most of my metrics. But I still want to check. I still want to make sure. And the funny thing is, this is probably the shortest chapter, how to analyze the deal, because what you really want to do is make sure you have the right sponsor, the right asset class, and the right market. Those are the tough parts. Now, when the deal comes, you look at it and you're like, okay, I knew this was coming. And so what we do at Left Field Investors, we created what we call a deal analyzer. And so we take maybe 30 different metrics and we put them in our deal analyzer, and it's an Excel spreadsheet that turns green if it fits our parameters and red if it doesn't. And so red doesn't mean don't invest. Red means this generates a question. And how I use this is as another check on the sponsor. I'm checking the deal to make sure it fits my metrics, and we'll talk about a few of those. But I really am also checking the sponsor. So what happens is, let's say I get 5 red flags. So I'm going to contact the sponsor and say, hey, I got questions on these 5 things. Now, I'm not as concerned with what the answer is. I'm more concerned with how it's answered. Are you responsive? Do you get back to me within 24 hours? It sounds like that's a little too nitpicky, but if you don't get back to me before I've given you my money, are you going to get back to me after you have my money? Probably not. So that's a test. The other is, how do you answer my questions? Do you know the answers, or is it difficult for you, or do you get upset that I'm asking questions? All of those are red flags. Like, most sponsors are going to give me very detailed answers, and that makes me not only feel better about the deal, but it also makes me feel better about the sponsor. So I focus on the metrics through the deal analyzer, and that's how I vet a deal.
Yeah, I like that. Well, let's bring up these metrics. What are some different metrics that you look at?
So, like I said, there's about 30 of them on that tool that we use, but everybody, I think, has their favorites. And some of the favorites that I have are rent growth, right? I want to see that and this is all looking at the pro forma. I want to see that they've had reasonable rent growth. I don't want to see 10% rent growth in year 1.
What's a pro forma?
Oh, thank you. So pro forma is kind of a prediction of how they think the financials will perform over the next 3, 5, 10 years, however long their time horizon is for that investment. So you're looking at, they do full financial reports based on assumptions that they make, and that's the pro forma. So the rent growth pro forma, if they say they're going to get rent increases of 10% in year one, I wonder how they do that.
Yeah.
Because most of the leases don't, they come due every, on all kinds of different dates. So how are you going to get everyone up 10% immediately? You're not. So a lot of syndicators will use, overly aggressive assumptions on rent growth. So, but if I see one that's 2 or 3% every year consistent rent growth, that makes sense, because you not only, and it depends also if they're a value add property, which means an old property where they put a bunch of work into it, you should be able to get more rent increase, right? Maybe you get 4% a year. If it's a property that was just built 3 years ago and there's no work to do to it, you might only get 1 or 2%. But those numbers have to be consistent. They have to make sense based on the property.
What are some other more important metrics?
So another one I like is break-even occupancy. So break-even occupancy is the amount of vacancy you can have and have the property still break even. So that just that shows you how much buffer you have. And I like to see at least 80%, no higher than 80% break even, because if something goes wrong and occupancy drops to 90 or 85%, I know that we're still making money and we would break even at the 80% mark. So the lower that number, the better. Another one that I like that I didn't even understand before was economic vacancy. So it's not vacancy, it's economic vacancy. And when I owned single family properties, I always threw in 5% for vacancy, right? Just in my underwriting and evaluations.
Right.
Well, there's more to vacancy than just someone not being in an apartment, right? So economic vacancy includes vacancy, concessions, which is, throw in a free month's rent or a TV if you sign now or something like that. Bad debt, which means uncollectible, stuff you didn't collect. Loss to lease, which is the major one. So loss to lease is if the market rate for an apartment that like you have is $1,000 and you're only collecting $800, that's $200 of loss to lease.
Oh.
And so that's a real driver, right? If you have big loss to lease, you get rid of that, then your vacancy goes way down. And then there's actual vacancy. And then the last one is non-revenue units, like if they convert one unit to storage or something like that. So all of those add up to economic vacancy. And I like to see that economic vacancy at about 8%. If it's much lower than that, then that's one of the questions I ask. Why is economic vacancy so low? If it's below 5%, then I'm having a hard time believing it, unless it's in someplace like Boise, Idaho, where someone told me there was like 3 vacant apartments in the whole town.
Yeah.
So those vacancy numbers I would believe, but you always have to put everything in context.
So economic vacancy includes that 5% of regular vacancy that you would typically budget for?
Yes, absolutely. Okay. It's all of those.
Okay, sweet.
Yeah. And so another metric I like to look at is property taxes. So usually when someone buys a property, the county reevaluates the taxes based on the new price that you bought it at, right? So taxes should be higher. And so what I look at in the pro forma, which is a prediction of what the tax burden will be, is I want to make sure that the current taxes are lower than what they're projecting in the future, because you're expecting the taxes to go up. So I just like to make sure, that's another place where a syndicator could kind of fudge the numbers to make the returns look better, but in the end, they won't be better.
Is there anything else with regards to the metrics?
I think everybody needs to find their 4 or 5 favorite metrics or what they really want to look at and concentrate on those. One of the things, and I mentioned this, but I think it's worth repeating, is that part of the process of evaluating the deal is the continuation of the evaluation of the sponsor. And so I really use the deal information, the deal metrics, to do a double check on the sponsor. Do they understand the deal? Do they know what they're doing? Are they going to communicate with me? And are they going to be responsive? I think those are super important things, because there's nothing more frustrating than sending someone $50,000 and not hearing from them again.
Oh yeah. You need a sponsor analyzer.
Yes.
Sweet. Well, that concludes Chapter 7. We're now headed to Chapter 8. Welcome back to the Masterclass. We are now on Chapter 8. what to expect before, during, and after investing in a syndication. From what I gather, passive investing doesn't seem so passive after all we've talked about. We've gone over how to pick a sponsor, an asset class, a market, and a deal. But can you kind of put a bow on this and put it all together for us? Can you talk me through the process of investing in a syndication?
Sure. So you're right. It doesn't seem passive because it is very active at the beginning when we're doing all those things you just mentioned, right? Screening the sponsor, the deal, the market, the asset class. It's afterwards that becomes more passive after you've made the investment. And also, once you get more experienced and you build a relationship with a syndicator, it's going to be even more passive because you'll know the deals that they're going to send you and you'll spend even less and less time on each deal. So it is active in the beginning, but it becomes less and less as you move forward.
Okay, so let's break it down step by step for our viewers who have been watching. What's the first thing we need to do? What do we want to do before we actually invest in this syndication?
Okay, I like breaking it down this way. So first, you want to find a sponsor. And again, Left Field Investors, we have a sponsor overview, which is kind of small summaries of a bunch of different sponsors. We also have the sponsor screener, which helps ask you questions. So again, if you're using your community, this is helpful. So first is find a sponsor. And to do that, you need to interview a sponsor, review that sponsor's past deals, and you can use our deal analyzer to do that. And I recommend people looking at past deals and ask the sponsor, hey, can you send me your last deal? So you can kind of get a feeling for it when the actual deal comes in. Mm-hmm. And then when they send you a current deal, you're going to want to analyze that deal using whatever tools you have. Then you're going to make your investment decision, and you're going to say, yep, I'm going to do it. And if you're going to do it, you submit what they call a reserve. Now, there's hard reserves and soft reserves. Soft reserves are ones that you can back out of. You could say, yep, I'm going to invest $50,000 in this, because sometimes you have to invest before you have full information. You have to commit because there's so much capital on the sidelines waiting to invest. Mm-hmm. So that's a soft reserve. You can back out if you want. Then there's hard reserves, which is if you back out, that syndicator will not likely ever let you into a deal again. Wow. So a hard reserve, you need to know you're making a hard reserve, and you can ask them, hey, is this can I submit a soft reserve, or is this more committed than that? And then in that process, you may also have to show that you're accredited if it's a deal that requires you to be accredited. And for that, they either have you fill out a form, like there's websites that'll prove that you're accredited, or if you have an accountant, they'll often write a letter that says, yes, he's accredited.
Okay, so that takes care of everything we need to know before the actual syndication, but now we've sent that reserve. What are we doing now during the syndication?
So you're still kind of in the before, but you've made the decision. So the during, to me, this is when you are signing the subscription document. So you've already committed, so now they're going to send you all the documents you need to sign. Yeah. So you're going to review and sign the subscription document. You're going to sign the PPM, the private placement memorandum. You're going to review the operating agreement, make sure that's all good to go. You're going to get the wire instructions. Now, this doesn't seem like it's a big step, but for me, what I've learned is you want to get those wire instructions securely, because a lot of the syndicators will just send it in an email, and there's been a lot of wire fraud.
Absolutely.
And so what I do is I either get the instructions and call and verify them, or what I usually do is I ask the syndicator to send it in a DocuSign or some other kind of secure document, so that I never wire money just that I got the instructions on email without verifying it. So that's very important. A lot of syndicators they have portals on the internet where you can go in and see the investments, and they'll just post them there. Mm-hmm. So make sure you're sending it securely, then you send the wire, and that's kind of the during. Now you're just done.
Yeah, you want to double, quadruple, triple check that one.
Right, and part of that triple check, thank you for saying that, is once you send the wire, confirm that they got it. Mm-hmm. Right? I always send an email to the sponsor saying, just sent the wire, let me know when you get it. And then I follow up with them until they give me written confirmation that they've received the wire.
I do the same thing on a smaller scale on Cash App. I'll send $1 first just to make sure they get the $1. Yeah. All right, so what is the process like after that?
So after is now, we're saying after you made the decision to invest and you've sent the wire. So now we're talking about during the investment. Right now the investment's just going on. So what you need to do is save all the documents. And this is kind of tedious, but if you don't do it now, you're going to regret it. So you save all the documents, right? The signed documents, the PPM, subscription agreement, the offering memorandum where they're giving you all the details. You save all of that stuff, either paper files or you can save it electronically. Then you enter the deal in whatever kind of tracking system you have. Now, this has been a real problem for people is there aren't any official ways to track this. And what you want to track is you want to track your distributions, make sure they're coming. You want to compare those to the pro forma, what they said they would send you. And if you only have 1 or 2 deals, Excel or something like that is fine. But it gets complicated when you have 20 or 30 deals and you're tracking all this stuff. So at Left Field Investors, we've developed a portfolio tracker. And it's an online web tool where you can put all your deals and it'll help track stuff. So that's what I use. And the things you want to track are the date you invested, the amount you invested, the name, obviously, then the sponsor's name and the entity that owns it, because those are going to be different. How you invested. Did you invest personally? Did you invest with your own LLC? Did you invest through your Tribevest tribe or a trust? And then some of the financial assumptions from the pro forma. The expected annual cash flow, the IRR, which is internal rate of return for the life of the deal. I'll talk about that in a second. And then if there's refinances expected, when those come in. And then you're going to track your distributions, compare them to expected, and then you're going to track your K1s.
What was that IRR you were talking about?
Okay, so IRR, it's really complicated to calculate, but basically what it is it's just using the time value of money, saying that if I receive $50,000 today from my investment, that's much better than $50,000 that I receive 5 years from now. So all it does is it brings everything into the present tense as far as money. So it allows you to compare 2 different deals that have incomes at different times and compare them as far as what the returns are.
Oh, okay. Then you'll be able to maybe also calculate if you're missing out on opportunity costs by investing in something quicker that you'll receive your money back quicker for now.
Exactly. And you always want to, it's a great point, because you always want to receive your money faster and pay your taxes slower. And so if you can figure out how to do both of those, that's how you're really making money.
Nice. That concludes chapter 8. On to the next chapter. Welcome back to the Masterclass. You made it to the final chapter, chapter 9, and my favorite chapter. How to invest with a tribe. Jim, you're a part of 5 tribes and you're a mentor of 3. Why are you so attracted to tribe investing?
I love creating and working with a community, and that's part of it. It's the reason I started Left Field Investors, was to learn, network, and grow with other people who are interested in this too. And part of it is these type of investments have not been accessible to everybody.
Yeah.
And part of my passion is sharing that anyone can do this. You can do this if you want to do this. And the easiest way to do it is with tribes, because let's be honest, most people don't have 50 grand that they can invest at one time and regularly to get that diversification, right? If you're investing 50 grand, it's going to take a long time to save that up. And tribes solve that problem. Group investing solves that problem. You can get into many more deals, you can have the diversification, you can get into real estate, and you can learn and grow with others. And that's building a community, and that's what I'm passionate about.
5 tribes, are they all investing in like the same thing, or can you kind of tell me a little more about them?
Yeah, so they're all very different, and they're all established for very different reasons. So I'll go through them so you can understand maybe how tribes work a little bit.
Yeah.
So the first tribe I was in was a couple of my former financial advising clients who they're highly paid professionals, and they want to be in real estate, but they don't have the time and they don't have the desire to learn about it. And they knew I was doing this passive investing, and so we figured, hey, let's do it together. And Tribevest made that super easy. So for those guys, I find deals, I will call or text them and say, hey, do you guys have any capital? If they do, then they'll say, okay, let's do it. If they don't, then we'll wait for the next deal. So they don't get involved in the deals at all, other than knowing maybe the asset class. And they're just relying on me to do that work for them. And the reason why it's fine with me doing that, I'm fine with that, is because I'm doing this investing anyway, but partnering with them, we can get into more deals and we have the whole diversification thing. So this is a very passive, they're very passive, and I'm just finding the investments for them.
Do they supply the money and you supply the expertise?
We contribute equally, but so we split it 33, 33, 34. So I get, of the proceeds, I'll get an extra % for the legwork that I'm doing.
Got it.
And so some of the tribes are set up that way. Like there's another one of my tribes, my second tribe, which somebody else manages. Another one of the founders of Left Field Investors manages. But this one, so I remember I told you about the syndicator that we really liked that was getting me a lot of passive loss through the bonus depreciation. Well, they come out with a deal every month at least, maybe even more, and their minimum is $25,000, and they have great historical returns. So you can't be in every one of those deals, right? Because if there's 12 deals a year at 25 grand, that's just too much. But how do you pick which one to be in? Because you don't know which one's going to be the rock star and which is going to be just average. And for them, average is 30% return. So
it's a great average.
Yeah. So we decided, hey, let's team up. So me and this other founder and some of his family, 5 of us got together and we said, we'll just invest in every deal. So now we put the minimum's $25,000. So every time they come out with a deal, we all chuck $5,000 into our Tribevest account, invest in the deal, and off we go. And that one, the other guy is managing that tribe, and so he takes a little extra cut for doing all the paperwork and all the processing and things like that. So that's a totally different purpose. And that tribe's grown a little bit too, because now we'll also get into other deals that we get interested in. But the one with that sponsor, those are automatic. We don't even talk about those.
That's awesome. I love that. Tell me about some of the other tribes.
So the third tribe I started was for beginners. I wouldn't have had to start this tribe if we had this masterclass. I could have just showed them the video. But basically, this is a mishmash of people. There's 11 people. Some are neighbors. Some are, I have a college friend in there. Some are former financial advising clients. These are people that they don't own any real estate other than their house. And they may never have gotten into real estate, but they heard what I was doing and they were interested. And so we started a group and we started contributing $100 a month. Right? And you know the minimums are going to be $25,000, right? So 11 people. It took us a while, and then we did a little lump sum. But it was during the pandemic when we did this, so we would do Zoom calls every couple of weeks where I would take a topic and I would explain syndication. I explain all the stuff we're doing here. And at the end, we found a sponsor, and it was non-accredited. This is what made me go find all these non-accredited people. We found a sponsor that we really like. The sponsor actually came to one of our Zoom calls and talked about how he operates and what he does. And then we invested in this apartment deal. And I mean, everyone's excited, right? It's people that, they don't necessarily have the means to put $25,000 in a syndication of their own, but now we're up to $150 a month. It's year 2. We're going to get to the second deal in August. And, it's just growing their portfolios, and it'll be a little extra boost to their wealth. And then they can either invest on their own, start their own tribes. It's just to grow it, right? So it's a learning tribe, and it's one of my favorite groups.
Yeah.
So the last 2 tribes are very similar. They're just made up of members from the left field investors community, people who've heard us talking about Tribevest and are interested, and they just wanted to get a group together. And they're all people who already know a little bit about syndication, but some of these were their first investments in syndications. So this group is a learning group for sure, but they're learning more not just from me, they're learning from the community. And they form these smaller communities together that are working together to increase their wealth. And that's the goal, right? You want to get in these communities where you can learn together and figure out how to do this syndication thing. And the whole goal is, we're not all trying to become rich, but we're trying to become time independent, right? So you're not trading money for time or time for money. You're building wealth so that you can have these passive investments that you don't have to worry about. If I go on vacation next week, I'm still going to have money coming in, and that's what passive investing is all about.
Out of all of your tribes, how many people are you investing with? Like, how many people are part of each tribe?
So there's a tribe that has 3, a tribe that has 5, 2 tribes that have 11, and another one I think has maybe 10. Yeah.
Wow.
So, and you can have any number. I think a lot of the benefits of the tribe is the community talking together and everything. But once it gets much past 11, I think it's going to be hard to get anything done because coordinating schedules for calls and everything. But honestly, the Tribevest website makes it really easy because there's messaging on there. There's all kinds of, and I think we'll talk about that in a minute. There's all kinds of stuff on there that even makes a large group easy to manage.
Mm-hmm. So you're involved in actively investing with over 30 people. How do you find people to be in your tribe?
Yeah, I never really counted the 30 people, but you're right. So they really just come together for whatever purpose it is, right? I talk about passive investing a lot because I'm passionate about it. And so you can start groups with friends, or you can start groups with colleagues, or whoever your network that you want to work with is. Or some of these tribes, I have people that I never met before. And I met them through a couple Tribevest people had heard of Tribevest, but not left field investors, and they contacted me. And so you want to have some familiarity, right? I think Tribevest a lot talks about investing with family and friends, and that's best. But there are some groups that I'm in where nobody knows anybody. They all know me because of my role at Left Field Investors. And so we've developed trust between me and you, right? So then an acquaintance of yours might then trust me. And that's, you need to have kind of the trust working out so that you can feel comfortable investing with people, because it's a lot of money, right? And again, Tribevest helps with that because the money is secure, it's online. You know, Tribevest has all the procedures and policies that kind of help with that trust aspect as well.
Once you've actually found a tribe, how do you know that everybody's a good fit for the group?
This is a critical step, right? You want to make sure that the tribe is aligned. Everyone understands that this is a long-term investment. You know, I tell everybody there's nothing more illiquid than a Tribevest tribe investing in syndications, right? These are long, and that doesn't mean it's bad. It just means understand that once you join this tribe, you know, you're dating now, but you're going to be married once you sign that LLC. And that means it's going to be difficult to get out of if you want to. So if everyone's aligned and understands, hey, we're investing for appreciation or we're investing for cash flow, then, you know, you kind of have everyone's understanding, right? So a good example for me is the first tribe that I told you about with 3 people in it, it had 4. And the 4th was my dad.
Yeah.
And it just wasn't a good fit for him, right? So we did all the Tribevest stuff, and he was just having questions about things, and he wasn't really, it wasn't the right fit for him. And so we bought him out, and that was fine. There was no hard feelings, but that's great, right? And some of these left field investor tribes that we've started, we'll start out with a group, and we'll have a few Zoom meetings. Then everyone's talking, getting to know each other and talking about the tribe, and we'll have people drop out all the time, and it's great. And I tell the people to drop out, hey, no hard feelings, because this wasn't the right fit for whatever reason. Better get out now than later.
Yeah.
And then usually a couple more stragglers come in, and we, you know, and then the group kind of coalesces. Before we invest, we probably have 3, 4, 5 meetings, and people get to know each other, and there's emails and all that. So I think that's important. It's to find people that you know, like, and trust, that you want to build a community with. And you know, we've been talking a lot about the Tribevest community or the Left Field Investors community. But once you form a tribe, that's another small community, right? And so you need to make sure that you have people that you're going to be compatible with.
Yeah, absolutely. You know, in real estate and in business, a lot of times people say stay away from family, like don't rent to your family members, don't don't purchase property with family. But this really does spread the risk sometimes. If you can go into it with the Tribevest mindset and everything is transparent, they can see everything, it's all laid out on the table. Makes it safer to invest with those people, with your family and your friends.
Yeah, absolutely. And you know, talking about that, like how the process works is just you go to the website. Now, when I first started the website, you know, it's grown a lot and it's gotten a lot better. And now people ask me, hey, I need help setting up a tribe. And I say, no, you don't. Go do it. It's easy. And there's one of the guys in one of my groups, I send people to him now because he just set up his tribe. It was super easy. I didn't help him at all. And so people are now saying, hey, can you help me go on Tribevest and start a tribe? I say, no, call Alvin. He'll do it for you because he just did it and it takes 3 minutes.
Yeah.
You know, and there's, when you go online to set it up, Tribevest is going to help you set up your LLC, right? Because you need to form a company so that you're all equal owners or however you want to set it up. Then you're going to set up voting rules because you want to make sure that if you're making an investment, everyone's on board. And so for my tribe of 3, our rules are everyone has to agree 100% or we don't invest. My tribe of 11, we do 7 people, right? Because you don't want to drag people along who don't want to invest, but you also don't want one person to stop the show.
Right.
And so Tribevest helps with all of that. And they set up a business bank account for you. And then they do the same page, right? So that you talk about alignment and investing with family members. You want to make sure everyone's on the same page. So everyone gets together and figures out, all right, what's the process? What are we going to do? And everyone agrees to it. And that reduces some of the risk of investing with family or friends, I think.
So can you kind of sum up the Tribevest online experience?
Tribevest allows you to do everything from the website, from forming your LLC, funding, doing the banking, doing voting on, you know, are you going to invest in this or that, messaging, and you can store your documents as well. You can even send wire transfers from there, and it is secure. It's just like you're sending from the bank.
So that concludes our masterclass. Thank you so much for staying tuned with us during the whole thing. I hope you learned something. I know I did. Again, my name is Julian McClurkin with Tribevest.
I'm Jim Pfeiffer from Left Field Investors.
Until next time, see you next tribe.